Hey everybody, hope everyone is doing well and had a good day today. This is the Emini review for Friday, June 28th, 2024. And today's the end of the week, it's the end of the month. We're going to look at all the charts today, starting with the monthly chart. And the market's in a bull trend, but you can see here, tight bull channel, trend line break, and then resumption of the bull trend, but it's weaker. And that's what happens. Trends get weaker as they go on. And look what's happening here. The bears will argue. It's 3 legs up, not very symmetrical, so the distance between leg 1 and leg 2 is far greater than the distance between leg 2 and leg 3, so it's not great. But either way, this line is resistance. Bulls will take profits at new highs, and aggressive bears might sell. We know that we look at this chart, and June is a bull breakout bar. But if you've been watching over the past few weeks, or maybe the entire month, you know that it wasn't just a small pullback rally for the entire month of June, and it's kind of deceiving. So we have a bull trend bar here, but if you crack open the bar and look at the smaller time frame charts, you would know there's a lot of trading range price action, and that's more apparent on the smaller time frames. So let's look at the weekly chart and look at the past 2 weeks. So here's the first week, second week of June. A couple of okay bull bars, but look at the second two. The second half of June is very much sideways. And then especially this week, we have an inside bar on the weekly chart. Closing, the bears can say they claimed the close of the bar, but the reality is it's basically a doji, and it's basically a neutral bar. We don't have a good sell signal bar, and so we're probably not going to crash down below this bar. And most likely we're going to go more sideways. The bulls buying up here are buying momentum far above the average price. If they're buying value, they're buying below the average price or at the average price after it's been above for many bars. But in this case, they're buying momentum. And when the momentum starts to dry up, like it's doing here, it's more likely to go sideways. And there is an increased chance because of that we do just crash down to the moving average, kind of similar to what happened here. And then for the daily chart, coming into the day, by the way, if you saw my last video, you would notice that the prior day didn't look quite right. That's because usually I have the extended hours chart, the Globex chart. The reason for that is there's just less gaps on the chart. It's easier to read. So that's what yesterday looked like. But the reality is if you come into the day looking at the day only session, the daily chart, we have a small trading range bar the prior day. And what happens when you have a small trading range bar within a tight trading range, you will have an increased chance of an outside day. And even without thinking about that, you just look at the context. We're in a tight trading range. The odds are there are sellers above and buyers below. So that's the expectation coming into the day. It's a bad sell signal bar. If we fall below yesterday's low, there's probably buyers. And you don't even have to look at the daily chart to know that. If you look at the 5-minute chart, you know we've been sideways. So the odds were sellers above and buyers below. And then for the 5-minute chart today, one more thing I want to mention is the Globex session on the 5-minute coming into the day. Because it's always tricky. You have these rallies on the open, and you think it could be a bull trend day on a Friday. And it's frustrating to get trapped on a move like that, or to miss out only to buy late and then get trapped late in the rally. So let's look at the extended hours, Globex, and let's see what the market was doing coming into the day. So here's bar 1, This is the 5-minute chart. So here's what we have coming into the day. This big sell-off, but overall, it's a sideways market. I actually like to look at a higher time frame. That's just a personal thing when I'm looking at Globex. So this is what we see coming into the day. Big bear leg, but overall sideways market. Isn't it possible? What do I want to do here? Trend line. Isn't it possible that maybe we have an expanding triangle in the Globex session? And so here's what that would look like. A couple legs down, a couple legs up. Then we get that huge rally. It's a bull breakout, but the bulls need follow through. And then look at the next bar. Again, this is the 15-minute chart, but that kind of just can help give you a different perspective. But in either case, you don't need to look at the Globex chart to know why the rally wasn't ideal on the open, and I'll talk about it. Gonna want my bar counter. Okay, so coming into the day, just one more thing. I have yesterday's high and yesterday's low drawn. Because of what I said coming into the day, it's a small trading range day within a tight trading range. And so the magnets, the yesterday's high, yesterday's low, those are two important magnets the market might test. But we're expecting breakouts of either side to fail. So bar one gapped up, and we have a bull reversal bar closing on its high. Big tail below, and it did close above yesterday's high. That's good for the bulls. But look at the context. The context is not good for the bulls. This could easily be maybe two legs up here, one pullback, two, a buy climax, top of a trading range, maybe one, two. Different ways to look at it, even this. Maybe one over here, two-legged pullback, and then two. Not ideal to be buying here. The bulls have to do more to convince traders this is going to be a successful breakout and a bull trend. So at the very minimum, bulls need follow through here on bar 2. For now, there might be sellers above bar 2. And then bar 2, we had a bull trend bar. It's a good follow through bar for the bulls. So bulls might buy now. We have a bull breakout and follow through. But the reality is the breakout was only a couple ticks. And this might be the breakout bar that bulls want to see a follow through bar on. Strong enough up on bars 1 and 2, it's probably going to get a second leg up. And there's probably buyers below bar 2. And then bar 3, an inside doji bar. It's really funny. Look at yesterday compared to today, and the open's really similar, where you have these big bull bars closing near their highs, and then bar 3 is a disappointment bar. And again, this is strong enough up. You're probably going to get a second leg, but this is disappointing for the bulls. We're finally getting a breakout far above yesterday's high, and then this is what we get, a deep pullback, and then a sideways inside bar on bar 3. So not ideal. The bulls want to see momentum, and instead they're getting hesitation and overlap and confusion. There might be sellers above 3, but we're still expecting a second leg up. So not ideal. Probably buyers below bar 3. And then 4, going a little bit higher. There's no selling pressure yet. Well, I say that. These bars have big tails below, so at some point these bars were big bear bars closing on their low. But on this chart, all these bars are closing near their highs, so the bears have to do more. There's nothing to sell. The bears, they're not going to sell below bar 4. It's a micro channel with really all bull bars. Probably going higher, but you think about the context that I mentioned on the higher time frame chart over here, and it actually is helpful to know the entire range because I didn't mention the 20th That was last Thursday, and that's the possible top of the trading range. Let me see if I can find the 20th, and maybe we can mark resistance using the 15-minute maybe. Here's the 20th, maybe up here is the top of the trading range. So we'll just mark it with, we'll mark the high of that day. So just think about this rally so far. Bull breakout, but then disappointing entry bar, and then a lot of overlap with bars 3 and 4 overlap bar 2 a lot. That's a channel on a smaller time frame, so it's not ideal. So as far as buying above bar 4, you'd be buying high in a bull channel, and the overall context does not support a breakout here to the upside. And then bar 5, another bull bar, but big tail above. It's not a good sell signal, so bad stop order means good limit order. So there's probably more buyers below bar 5. Still a micro channel since bar 1. It is a bull breakout, and we're expecting a second leg up. And there's not enough selling pressure to be looking to sell, so we're probably going to go higher. 6 triggered the sell below 5 and immediately failed, which was expected. It's not the ideal entry bar for bulls, but it's not bad either. And 6 is the first pullback in the micro channel, and now bar 6 is a high 1 buy, but it's a trading range bar, and the context is bad. The breakout could be stronger. We have a doji, really a couple dojis now. With bar 6, we have overlapping bars, bars with big tails below. And again, the context, really not great. So not ideal to be buying a high 1 here, especially with a weak signal bar. And then, of course, bar 7, surprise bar, and look exactly where it went. That's the high of the 20th. So I marked, again, this is the, I don't know what I did there actually, because the high of today was below that low, so I don't know why that's here. It's not the same price. This is 55.76 and 3/4, and the high of this day is 55.88. So that's strange. We'll just ignore it for now. But all that's important is we know we're getting a high in the range over here, and the odds are there are sellers high in the trading range. So bar 7, as strong a bar as it is, there's always that risk that it's a buy vacuum test of resistance in a trading range. Bar 7 also, you've heard me say it before, oftentimes you get a report on bar 7, some news event. Whatever it is, I don't pay any attention to it, but it's important to know that it's going to happen, at least some of the time. So as surprising as bar 7 is, it's not all that surprising. It is a bull breakout of a channel. I mentioned this was a channel. We're getting the bull breakout. The bulls still need follow through. And this is just, bar 7 is actually a problem for the bulls. The very best breakouts are not climactic. They're orderly. They have uniform sized bars. And let me see if I can pull up an example. Actually, just the other day, it was around bar 18. I forget the exact day. Was it this day? I think it was the 17th. Yeah, right here. So this is an example of a strong bull breakout from bar 18. Bar 18, bull breakout bar, but still high in the range. Then another breakout bar, but way above all the bars to the left, closing on its high. Little overlap between the bars. And then even more, we have a tick gap. And look at the bars. They're fairly uniform in size. 4 points, 4 1/4, 3 points. Little overlap there, but again, 3 points. And then another bar, 3.5 points. Little overlap. Big bull bodies. This is a strong bull breakout. It's not climactic. Let me see if I can zoom out. It's funny because it is breaking out of a bull channel here, but the bars themselves, the breakout itself, is much stronger than what we're looking at today with bar 7. Bar 7 is a problem for the bulls for a couple of reasons. The reasons climaxes are a problem is swing traders, and you could even say scalpers as well. The problem with them is you have bulls who bought down here. You have bulls who bought anywhere. Maybe they bought the high one, taking a chance, but any bull who bought and got bar 7 is probably just going to take it. Bar 7 is almost 15 points tall. And that's about the range from the low of bar 1 to the high of bar 5. This entire range we got on bar 7. So traders are going to take that as a gift. They're going to take profits. The reason for that is the trader's equation. You can even set aside everything I'm saying with the higher time frame context and just think about risk reward. If you buy the close of 7, your risk is down here, your reward is all the way up here. What are the odds we get up here before we get to the bottom of this buy climax? It's probably not 60%. And even if it is 60%, you get a little follow through. Look at bar 10. So at some point, the equation gets really bad for the bulls. The context is bad. Everybody starts taking profits. So that's a problem with bar 7. The market's doing something that's low probability, and whenever it's doing that, it's usually better to just wait for something you're comfortable with, wait for something that's higher probability. Because if you're trading and trying to make a living trading, you need to have a plan, and you need what you're doing to be consistent. And when you get the low probability event, it's in the name, it's low probability. It happens infrequently. And it can be dangerous to try to capitalize on these events because they can quickly reverse. And I think about it like everybody thinks about trading in the beginning like it's get rich quick. It's so easy. You just buy, get this huge bar, and you exit or whatever. But the problem, I think Al puts it this way, it's better to hit singles than try to hit home runs. If you can just hit a couple singles every day, you're going to do great. So there's no need to have any issues missing out on this. And then more follow through. Bar 8, another bull bar. Some selling into the close, probably buyers below, but we're getting far from the moving average. It's climactic. The moving average can't keep up. This is, again, it's parabolic. Maybe 1, 2, 3 pushes up. We're getting the strongest bull bar after this entire rally. And we know in the higher time frame, if we look to the left, we're getting high in the trading range. So that's an increased risk that this is a buy vacuum test of resistance and an exhaustion gap rather than a breakout gap or a measuring gap that should lead to a bull trend. More follow through on bar 9. But it's everything I've been saying. The context is not good. This is low probability. And it's hard to want to buy when you have a possible third buy climax, and it's very climactic, high in a trading range over here. And then we got bar 10. And bar 10 erased the past 2 bull bars. And that's a big problem for the bulls. Bulls who bought the close of 9, big bear bar 10, very disappointed with their entry bar. They'll use any bounce they can to exit. The reality is, even though it's this many bull bars up, if you get a bar like bar 10, it's probably wise to exit any long below bar 10. We could easily crash down and test the moving average. When it's doing something parabolic like this, and you're far above the average price, it's usually best, Al says, to exit below a bear bar, closing below its midpoint. And bar 10 certainly qualifies for that. But of course, the reality is this was enough up that it should get a second leg. But that second leg could be really minor. And what we could be getting is a buy vacuum on the open, a bull trap, an early high of the day, and then a reversal. That's why I pointed out the Globex chart as well. This is not a great bull breakout. So one of the targets below is the bottom of this buy climax. Bulls by the close of 10, so bar 11 is an inside bull trend bar, but 11 is just a bounce that the bulls are hoping will get them out at break even. Bulls by the close of bar 9, maybe they make a mistake. Maybe it's a high frequency trading firm, they're scalping for ticks, or maybe they think it's going to continue, the low probability event continues. We have a bull trend today, but when you get bar 10, you know your premise is wrong, and you might scale in lower, use any bounce you can to exit at break even. And then 12, we could not get back to the close of bar 9. Bar 12 becomes a second reversal down. We reversed below bar 9, pulled back, and reversal on bar 12. If we trigger the sell below 12, bears will short and bulls will exit. Not the greatest signal bar. In the past 5 bars have a lot of overlap, so this is a trading range. More traders might prefer to sell above 12, but it's not unreasonable to sell below 12 and scale in higher. 13, testing higher. Now we have 2 legs up after this bear breakout. So breakout on 10, leg 1, pullback, leg 2. The bulls have tried with 3 attempts after bar 10 to get back to the 9 close, and they're not getting there. And now we might have a wedge, bear flag, and a second leg down. In that second leg, the reality is this could be a final flag, tight trading range after a climactic bull breakout, possible exhaustion gap. So rather than seeing bar 10 as leg 1, it might just be a leg in a trading range, a tight trading range. Then we get a breakout that resets the leg count. With bar 13, the reality is there's probably sellers above, bulls hoping to get out at 9 if they're lucky, and bears selling above. And then 14, that's a problem for the bulls. And 14 is a bar that bulls might give up below, and we can get a give up bar, which is where the bulls who bought up here, they know they're wrong, they're trying to get out at break even. They've had 1 attempt, 2 attempts, and on a smaller time frame, 1, 2, 3, and we're now reversing with a bear bar closing on its low, 14. Tight trading range, possible final flag far above the moving average after a low probability bull breakout. Wise to get out of longs below 14, and it's a reasonable swing short setup. 15 broke out far below 14 and pulled way back. It's common for breakouts of tight trading ranges to do that. When you're entering on a stop order, it's really not ideal in a tight trading range. So you sell, the market breaks out, but then it immediately comes back and tests within the trading range again. But think about bar 15 from the bull perspective. If you're a bull, what's your argument? Well, we have a big bull breakout, a pullback on bar 10. That's leg 1, complex pullback. Leg 2, so 2 legs down and a high 2 above 15. But what's the problem with bar 15? There's a couple of issues with bar 15. And first of all, it's a weak signal bar. It's a doji with a bear close and consecutive bear bars. So the bears it's very small, but 14 did break out below 13. So we have a bear breakout and follow through 14, 15. And then think about the context and think about what happened above. If we do get a breakout above 15 and a bull bar, what's going to happen up here? More likely the bulls are disappointed above, and they're going to use any rally they can get to exit their longs. And there's probably sellers above. This is a tight trading range. Bears are selling above if we get there. So 15 is not a good stop order buy. And if it's not a good stop order buy, it's a good limit order sell. We triggered the buy on 16, but it's a small entry bar in the middle of a tight trading range. The odds are there's more sellers above 16, maybe even selling on the close. The bulls wanted 16 to be a big bull bar, trapping bears selling above 15, getting all the way up here. But again, even if we got here, the bulls are disappointed. They're going to exit longs if we get there. It's just like bar 9 yesterday, actually. You think about what happened on bar 9. It's a second leg trap, 2 legs up in a trading range. Good looking bull breakout bar, but then terrible follow through. It's literally just like very similar. Bars 8 and 9 are like 9 yesterday, and then bar 10, very similar bars. Then you get this retest, and it's not all that clear on this time frame, but I bet if you looked at a maybe 2-minute chart, then you would see bars 11 through 15 are 2 or 3 legs up. We even have a pullback below bar 12 on 13. 2 or 3 legs up, testing the high close of 9, where bulls got trapped. We tested it to the tick, and look what happened. And that's basically the expectation here. But the problem here is it doesn't look like the bulls are getting there. They had a couple attempts. We sold off even further. The bulls are further disappointed. This might be a last-ditch attempt before the bulls give up. And look at bar 17. It's an outside down bar. So that's the give-up bar. That's bulls realizing we're trapped above. We're going lower. We're not getting out of this. We need to buy back. Or we need to exit our longs and look to buy lower. So they're exiting. They're selling. The bears know that. They're selling as well. And that leads to a big bear bar 17. 17 is a good breakout bar, but it's still above the moving average. And you can argue 3 pushes down. 1, 2, 3, climactic bear bar, testing support, the moving average after a big rally. It's all true. But let's see what it looks like on bar 18. Because if that's your argument, you're expecting 18 to be a bar, like maybe bar 11, a big bull bar, traders buy the close because we're on the channel line, and the breakout of the moving average fails. And then look at 18. If you're a bull, that's really disappointing. If you bought the close of 17, you're holding a losing position on the close of 18. 18, similar to 15, where we got a breakout, deep pullback on the breakout bar. But the opposite logic, who wants to buy above 18? The reality is not many traders. So if we do go above 18, it's a better sell. And instead we sold off on 19. So what we're getting here is a leg count reset. We had this breakout on the open, but remember what Al says, 50% of breakouts on the open reverse, and that's partly why I showed the Globex chart. This was an expanding triangle on the Globex session. So bull breakout, but bad context, bad follow through here, final flag, it's tight, and now we're getting the reversal. So leg 1 breakout, traders are selling for any reason, knowing that they can likely scale in higher and have a high probability of catching a second leg and avoiding a loss, if not making a profit. If we talk about always in, 19 is probably making it clearly always in short. Big bear breakout below the moving average. But the reality is, because of context, the price action might not have been clear up here. But this was a bad area to be long because of the low probability bull breakout, the disappointment, the tight trading range, bulls unable to get back to the swing high or the high close of bar 9. That's a problem. And then here, of course, more clearly, always in short. We tested this first target, the bottom of the exhaustion gap bar, and we went straight through it. Breakouts are succeeding. That was not support. We went straight through it and closed below it. Big enough breakout, as I said, probably going to get a second leg down. Traders can sell and sell more on a pullback. 20, another bear bar going lower. 4 bar bear breakout, and it's a sell vacuum straight back down to the high of yesterday. We had this low probability breakout of the high, went far above it, but then came back down and tested it, and that's where we're bouncing. On some lower time frame, there might be 3 legs down. You can see the tails on 18, 19, 20, but the reality is it's tight enough. It's probably a breakout, and any reversal will be minor and will lead to a second leg down. 21 inside bar due to bears taking profits. So it is a bull bar and it's at support, the high of yesterday, but the bulls need to see, will this hold? 21 is not an ideal low one because it's a It's an inside bar and it's a bull bar. There's probably sellers above bar 21. Bulls, they might buy below 21, but if they do, they're not expecting a bull trend. If you're buying below 21, it is a very quick scalp. And the same goes for bar 22. Consecutive bull bars, but look at the tail on 21. The tail on 21 represents selling into the close. So we rallied, pulled back down to the low of 22, and then rallied again. This is 2 legs up in a bear breakout. So that's 2 legs in a pullback. So traders will sell above bar 22. They'll sell the close of 22. Bull breakout 23. A little surprising, but still not good for the bulls. It's 3 small bars after these big bear bars. And so it's easy to get sort of locked in or zoomed in on the most current price action. Bull bar, another bull bar, bigger body, another bull bar, bigger body, increasing bull bodies, and a bull breakout. But you always have to ask yourself, bull breakout of what? Broke out of the past 3 bars, that's great, but it did not close above bar 20. And it could easily be a vacuum test of the moving average. We crashed through it. Bulls might have bought the moving average and got trapped, and they're looking to exit at the moving average. But what I said hasn't changed. Big enough breakout, it's a leg 1 breakout, and the first pullback will likely be minor. So if you sold the close of 20 and you scale in higher, you're probably going to make money. 3 consecutive bull bars, not ideal for the bears, but after a strong leg 1, some bears will sell below it and sell below 23. Sell above and below bar 23. 24. So it took the bulls 3 bars to get up here, and then 1 bar to get all the way back down. That's a low 1. It's a low 1 on a higher time frame chart. We can even see it here. It is technically a low 1 below bar 23, but bad signal bar, and probably disappointed bears on the close of bar 20 after a 3-bar rally. But this rally is mostly bears taking profits, not bulls buying. So now we have a minor second leg down, but this is all part of the trading range. And the trading range in a bear trend is a pullback. For the bull perspective, bar 24 is a double bottom with bar 20, 24, but the signal bar is terrible. It's a bear body, and after this huge sell-off, the context is bad. We're below the moving average. The odds are there are sellers above 24. And there might even be sellers on the close of bar 24. If a bull bought below any of these bars, this is not their dream entry bar, and they might just exit. 25, we're getting a small second leg to the upside. So leg 1, pull back. Leg 2, the bears want to sell higher. Maybe they want to sell the moving average. So maybe we test the moving average before we start falling. But this is all minor, so you can't be buying expecting a bull trend. It's a very low probability bet. Even though 25 closed on its high, what's the difference between bar 25 and bar 28 yesterday? They're both bull bars closing on their high. They're both second reversals after these big bear legs. What's the difference here? Well, this one might have been a third leg down with 1, 5, 27. So it could be a wedge. This subdivided into 2 legs, bottom of a trading range, support. It made sense for bears to exit above 28, but 25 today is different. You can argue 2 legs down on 18, pull back, second leg. But again, the reality, this is really just 1 breakout, and it's leg 1. And we were expecting the breakout of yesterday's high to fail. And so what are the odds we're going to rally all the way back up? This is the high of yesterday. We're expecting this support to fail. We're actually expecting to break below it. And so you're betting against a strong leg 1, which hasn't had a second leg yet. The context is bad. The signal bar is fairly small, and it's within a tight trading range, which is a bear flag in this context. Probably sellers above. 26, we're finally testing the moving average, but look at the tail on 26. 26 is basically an outside bar. It's not technical. We didn't fall below the low, of the prior bar, but it does function like an outside bar. And when you think about what an outside bar is, and you think about the context that it's occurring in, it's an expanding triangle on a smaller time frame chart. And it's happening in a second leg, 1, 2, and an overall bear flag at the moving average. This is about the worst place a trader could buy because it's sort of a nested pattern. It's an expanding triangle. It's high in a trading range on that bar, but it's also high in a trading range in here. And it can be hard to see, but some traders will even call it a wedge. We rallied on 20, rallied on 23, and then 26. So 3 pushes up to the moving average after a strong bear breakout. Everybody's going to sell here. At least that's the higher probability event. And then 27, no surprise. Sellers above 26, big bear trend bar. Might be trend continuation to the downside. We've had 2 legs up to the moving average. Bulls exited and bears sold. And now we're getting a trend bar to the downside. Outside bar, I just mentioned an outside bar is a trading range bar. So what gives? Can you buy below 27? Well, not really, because you want to trade the always in, and we're still always in short. So if you're buying below 27, you're trading counter trend. And if you are trading counter trend, that's not an optimal entry. If you're buying low in a trading range, at least wait for down here. But it's really not wise when this is probably a bear flag. We're probably getting a second leg down. 1, 2, and then this measured move of the wedge bear flag, we could easily come down here. And look where we're testing, breakout point to the left. So no, you cannot buy below 27. Inside bar, 28, so IOI, we have breakout mode on the past 3 bars. And we know that the market's in breakout mode, it's in a trading range. But for now, until this trading range reaches about 20 bars, there's still directional probability to the downside. We're still always in short, expecting a second leg down for the bears. And the supporting context is the high of yesterday should not hold that support. I should have mentioned, so inside bar reduces the probability for breakouts in either direction, so probably sellers above and buyers below. But again, with the context, not wise to buy below. Outside bar, 29, not technical, but functions like one. Probably sellers above, and again, not optimal to buy below when you're expecting trend resumption to the downside. It is a trading range, and you can buy below it, but you have to know how to manage the trade and be quick. 30, we had the outside bar sell trigger, and so we had buyers below on bar 30, and that's a scalp. And the bulls, look at the bar range, that's 2 3/4 points. The average bar range has been maybe 4, 3, 7.5, 6.5, maybe it's about 4 points. And that's less than the average bar range. Bulls not even getting 1 average bar range in a bar for that scalp. That's disappointing. 30, what about buying above 30? Second reversal. And maybe you can argue it is breakout mode and a possible final flag. Maybe it's a triangle. The market's getting condensed. It's contracting. But look at the past 3 bars. They're trading range bars. There's probably sellers above 30. The context is bad to be buying. You have the falling moving average above. And bulls who are buying here are scalping. And so until there's more proof that the bulls have strength, it's not wise to be long. And then outside bar, 31. Bulls scalp out and bears sell above 30 because 30 is a bad stop order. So bad stop order means good limit order. Not ideal for the bears. This is pretty weak, maybe 2 legs down to the bottom of a trading range. We might bounce here, but this is still all a bear flag, and we're expecting trend resumption to the downside and a bear breakout. And there it is on bar 32. 32, bear trend bar, closing well below the flag, and I'll redraw the measured move. the wedge bear flag. Maybe this is your target. And we're falling quickly on 32. 32 might be sell to close, trying to catch a second leg. Leg 1, leg 2. And as far as buying, I would not. Follow through 33, so the bears get a breakout and follow through. 33 is kind of similar to bar 15. Can you buy above 33? Probably not. It's too tight for the bears. Tight bear channel. Yes, it is 2 legs down, but where's the obvious support to the left? Well, look at my cursor. Let me look to the left. We have a breakout point down here. So why would bulls buy here? Or why would bulls buy here when they can buy a breakout test and maybe the measured move? There's reasons for the market to go lower. So bulls are not going to buy. Bears will sell above 33. If it triggers, it's a bad stop order. And the first pullback will likely be minor. Almost outside down 34. Traders tried to sell above 33 but did not get triggered. Another bear bar, and here you can argue 3 pushes, 32, 33, 34. So we went bounce, getting close to this magnet, testing the 60-minute EMA, but tight enough down, probably going to get more to the downside, and this was strong enough for a second leg itself. Here's a low of yesterday. I think this line is also important. Inside bar 35, similar to 21, it's probably bears taking profits, but whenever you get close to an obvious magnet like this, the market often gets close to it and then stalls, but then eventually gets there. It's probably sellers above 35. The fact that it's an inside bar is actually good for the bears and bad for the bulls. 36 bull bar, closing near its high, and a bull breakout, but it's a breakout of an inside bar, so it's expected to pull back within a bar or so. Maybe we test higher, like I'll extend this, and this is a bear breakout 32. Look to the left, here's the breakout point, the low of 20. Maybe we test this line and then reverse down. This might have been strong enough for its own second leg, but it's in the same way that bar 11 was strong enough for a second leg, or 21 through 23 was strong enough for a second leg. And that, what I mean by that is that this is a minor reversal. Might be strong enough for a minor second leg at best. Outside down 37. So if a bull bought below 36, that's a problem. And it is an outside bar, so it's a trading range bar, and we've been sideways for 5 bars. There might be buyers below 37, but if they are buying below, they're scalping. We still have this magnet below that we're probably going to reach. So that's a problem with being long here. And then another breakout, 38, and we're falling straight through that support. At this point, we have a tight bear channel, and so we do have 3 pushes, 1, 2, 3, but this could all be one leg. This is a minor pullback, and every third bar, the reason I like having multiples of 3 labeled is because it corresponds to the 15-minute chart. So if you can imagine, this is something really important I hear Ali say all the time, and that is traders need to be able to understand the higher time frame context and sort of have an imagination. If you have to glance at a chart, that's okay, but it's better when you can just visualize the 15-minute chart in here, and that goes for the smaller time frame charts as well. And that's why it's important to know, like, for example, this was a great example here. 4 consecutive bull bars, but lots of overlap, a pullback, big tails, small bodies. You know, this is a bull channel on a smaller time frame. And what is it retesting? That's sort of a context thing. But the bars themselves, that's a channel. A bull channel is a bear flag. And then here, what I'm talking about here is, sure, maybe it's 3 pushes down, and we have a pullback here. But if you think about the 15-minute chart, every third bar, every bar that's labeled is the close of a 15-minute bar. So here's a bear trend bar, and then here's another bar. And we do have a pullback, but it's a minor pullback on either chart. And if you just go to the 45-minute chart, this is all just going to be a bear breakout that should go lower, and any pullback will likely be minor. So as far as Buying 38, betting it's an exhaustion gap and maybe a third consecutive sell climax. It's better if you're at support like the low of yesterday, but instead there's room to the downside and the market's accelerating down, so not ideal. Probably going lower. 39, it's a bull bar closing on its high. So what about buying? It's like I just said, you can buy. Well, I sort of take that back. I would not advise buying above 39. It's a tight bear channel. You do have a bull bar closing on its high, and bulls might start coming in below it, but as far as buying above it, I would not. I think the channel down is too tight, and this breakout was strong enough for a second leg. Maybe we test the breakout point 34 low and then reverse from there. Hesitation on 40, we triggered the buy but went sideways, and that's not what the bulls wanted. Low one short below 40, there might be buyers below and a deeper pullback. And then another sideways bar, 41. On some time frame, a smaller time frame, this is a spike in channel bull trend. We have a spike on 39, a pullback, and then overlap, slightly higher high on these bars, so it's a bull channel. Bull channel means bear flag, and this is a minor pattern. The reality is it's probably a bear flag. 42, a bigger bar. Is it bigger? Bigger body, but same size as 41. I thought it was bigger. It would have been a bigger problem if it was bigger, but why is the body growing? It's a bull breakout attempt of a bull channel on a smaller time frame. We're testing a breakout point. Maybe the bulls are trying to get back to the open of bar 35 and close that gap, and that's where we're testing on 42, but there's probably sellers there. 43, a bear bar, high one buy, but bear body. Odds are there are sellers above. It's a micro channel, 39 to 42, but on a smaller time frame, it's a channel, and there's pullbacks, so this is not very strong. This doesn't necessarily need a second leg, but we might get a second leg and test maybe the moving average. But 43 is a bad stop order buy. And then look at that. It's a vacuum test of the moving average. We have a bad stop order, signal bar 43, and then 44 just went straight to the moving average. It's also testing to the left where bulls got trapped on 36. So this is an area of resistance. It's a sell zone. So don't let 44 trap you into buying. This is a bear channel, and bears sell rallies in bear channels. And so here, this is a place for bulls who are scalping to take profits, and it's a place for bears to enter short. We hesitated on 45. For the bulls, they wanted another bull bar, like 44, to just cross the moving average and further trap the bears who sold above 43. There are trapped bears above 43, and they're scaling in higher. But now 45 is starting to disappoint the bulls. It's a high one after two legs up in a bear channel at the moving average. Bad context to be long. Inside bar 46. The market's contracting. It's breakout mode on a smaller time frame. We might get a bull breakout attempt, but then reverse down. There's an increased chance of an outside bar here. And what about buying below the inside bar? I would not, because it's two legs up to the moving average in a bear channel. There's probably more sellers in this area. We got the bull breakout attempt. 47, not an outside bar, but we broke out above and then pulled back. 47 is a bad sell signal bar, but context always trumps the signal bar. So if I had to choose what to do here, buy or sell below 47, I'd rather sell. We're still always in short. And then 48, you can see the entry bar made up for the bad signal bar, and that's all the bears needed. Bulls who bought below, they're trapped on 48. They might not try to get a second leg up. They know it might have been two legs up, maybe even three. 1, 2, and then a small third one. So the bulls might just exit here. And 48, we're probably going lower. 49, we have bear breakout and follow through. Decent bear bars closing on their lows, probably going lower. One problem the bears have here now is that the bulls who bought below 34 made money. The market might be in a trading range. They closed this gap here. You can see we closed above it. That's good for the bulls. But you look to the left, maybe I should have mentioned this earlier. We do have open gaps. The bears have open gaps. That's a problem for the bulls. What that means is there's bulls trapped above, and trap traders are fuel, and those bulls have to exit at some point. Although you can also think of it this way: bear breakout, small two-legged pullback, and then this is the bulls giving up. Then there's another one, and this is the bulls giving up here. Now we're going more sideways, but we still have open gaps for the bears. Or you could look at it either way. There's open gaps. Bulls who bought below bars, or really who bought anywhere, are trapped. Inside bar 50, but likely minor reversal. Probably going to go more sideways to down. 51 a bear bar, but I said this is fairly sideways. The market might be converting into a trading range, but for now we still have lower highs and lower lows. So if anything, still always in short. We have the low of yesterday, which is a magnet, maybe the low of a trading range, and it would not be surprising if the market got there before the bulls wanted to buy. Inside bar 52, but inside bar lowers the probability. Sort of in the middle of a trading range, not ideal to be initiating trades in either direction, but especially not buying here. It's a micro channel and bad context. Moving average is falling. Overall, bear channel. We triggered the buy above 52 and then immediately failed. Low one below 53. Not great. It's in the middle of a trading range, but buying below it has an added risk. 54, we triggered the stop order sell below 53, low one, middle of a trading range. So we did have a small scalp there, but it's so small. This bar is 2.25 points tall. Not really worth doing it. What about buying above 54? Second reversal. We triggered the buy above 52, pulled back, now 54. It's a bull bar closing on its high, but very small. This is minor. And we're in a bear channel with magnets below. Not ideal to buy. 55, it's a outside bull bar, testing the moving average again. But look what happened the last time. In the last two times, really, we tested the moving average. We found sellers. So that's the risk you face if you're buying here. The reality is that bulls who bought lower are scalping out here. Inside bar 56, high one buy, bad context, sellers above. 57, we traded above it, but now we have, you could say, two legs up. 56, pause, and then 57, testing an area where bulls got trapped, buying below 45, or any of these bars. Sellers above, not ideal to be long. And then you can see we tested the 45 low, maybe went above it by a tick, and then reversed down. 58, if you were long, that's a bar to get out of longs below. Low too short for the bears, you can sell. We're in a bear channel at the moving average, and it's a good signal bar. And that's why everybody sold on 59. A little bit of a climactic bar, and at this point you can argue it's a late leg, maybe leg one, leg two, and then here, leg one, leg two. Overall, mostly sideways, but we are still getting lower highs and lower lows. We got a breakout here. So it is a bear channel. But think about bear channel. In a bear channel, bears sell above bars, they sell rallies, and then they get out below bars, and they buy back their shorts at new lows. So that's the problem with selling here. Plus it's a big bar, climactic bar. It's going to attract profit taking anyway. And the expectation after a bar like that is 1 to 3 bars sideways. Inside bar 60, low one short, but possibly low in the bear channel or a trading range. Not the ideal short. What happened there, we had this breakout 59 with breakout points here. Bulls buying below here, betting it's a trading range, they get trapped. 60, test those. Bulls who bought there, scaled in lower, they get out, and then bears who missed the sell, they get in there, and we fall for a small second leg. It's minor, 1, 2. And then a small trading range bar, really not ideal to buy. I don't know, if you were daring, you can buy, betting it's 3 legs down, but you don't have a good signal bar, and the buying pressure isn't all that great. You still have open gaps above, and the obvious low of yesterday magnet below, probably going lower. We triggered the buy and then reversed. It was a bad stop order, which means a good limit order. 62, bear reversal bar. You can call it a low 1, you can call it a low 2, double top with 60. Not the greatest context. And now 3 bars, mostly sideways. It's like a bear channel in here, these 3 bars. So we might bounce. But again, we're probably going a little lower to the low of yesterday. More sideways on 63, bear channel on a lower time frame, but nothing to buy. And then falling a little more on 64, getting very close to the low of yesterday. Probably going to get there and see what's there. Might have support and rally again. And you can argue, not a great shape, but 1, 2, 3 pushes down to the bottom of a trading range. Pause bar, 65, as is so common. You get close to support or resistance. The market pulls back right before it, only to get there fairly soon after. Inside bar, 66, lowers the probability for breakouts, probably sellers above and buyers below. And we're finally testing that low of yesterday magnet on 67. 1 tick breakout, the bears still need follow through. Would have been better if they closed well below it. But we are expecting buyers below this price because of the trading range on the context on the higher time frame. So no follow through for the bears. What about buying above 68? Some traders might, taking a chance, but this is tight enough that any pullback is probably minor. The bulls might get to the moving average before a second leg down. Small signal bar, so small risk means low probability, good risk reward. Didn't trigger it and instead fell on 69. Might be a nested 3 legs, 1, 2, 3, and then in here, 1, pause, 2, pause, 3. On the bear channel line, this is a place for bears to take profits. 70, same thing with 68 with buying above 70. It's not ideal, it's probably minor. This is tight enough that the first reversal will probably fail. It's actually a micro channel since 62, so that's a lot of bars down without a pullback. The first pullback probably has sellers above, but selling above a bull bar closing on its high is not ideal. And then a bull doji 71. We might get to the moving average, but more likely it's a tight trading range. It's a minor reversal. We test a little higher and then come back down. Inside bar 72, low 1 short. The bears hoping. You could view this as a breakout on a higher time frame chart and then a low 1 short below 72. But think about the context. Big up, big down, overall trading range, and now we're at the low of yesterday, which is support. Not an ideal place to be selling. Big surprise on 73, but it's a breakout of a bear channel. One, two, 3 pushes down, big climactic bar. Whenever you get a huge bar like 73 late in a sell-off, that is more likely exhaustion. And so it's easy to get trapped into selling those big bars. Maybe you missed selling on the way down, but the reality is that this is more likely exhaustion and we'll probably test the high of 73 before we go for a measured move. It goes back to that trader's equation. Once again, you think about it. Say you sell the close of 73. What are the odds we get down here before back up here? I don't know. 50-50 at best. But you can see what just happened. We sold off to this channel line and reversed. So it's probably less than 50-50. And if that's the case, you can't take the trade. So bears won't take the trade. Bears will take profits. And aggressive bulls will buy, betting on reversion to the mean. We're in a tight trading range in here. Bear breakout, but late in a trend in an overall trading range. So more likely exhaustion and a reversal. 74 is sort of expected, and not that, I don't know if I want to put it that way. You're expecting 74 to disappoint the bears, I'll put it that way. Bulls, they buy, and they get a bar like 74. Maybe some of them hold, but it's more of a scalp. But the first target, probably the breakout points, 69 low, We tested it on 74, so some bulls will take profits. Then you have the high of 73, then you have the moving average, and then other breakout points to the left. But as far as 74 and buying above it, it's still probably minor. And traders will buy below 74. 75, there was more to the upside. It looks like we might have gone for a measured move of the bar. You can see we came very close, maybe within a tick, and then found sellers. And look to the left. That's what's expected here. The micro channel, sellers above, the moving average resistance. And you're expecting, after a sell-off like this, you're not really expecting a reversal straight into a bull trend. You're expecting the conversion into a trading range, and that's what we're getting here. A bear leg in a trading range, and then maybe the first of a couple bull legs in a trading range. 75 is a bad stop order sell, probably buyers below. Inside bar, 76, lowers the probability for breakouts. Lots of overlap for the past few bars. And it's really just a trading range. Mostly below the moving average, probably sellers above 76. And then outside down, 77. What about selling? 77. 77 is probably a bar that it would normally, how do I put it? When I was starting out, I remember when I was first studying AL, and I would miss this entire trend, and then I would see a bar like 77 finally after the exhaustion gap. I'd see, okay, it's 2 legs up to the moving average, good signal bar, low to short in a bear trend, but it's so late in the trend, we're more likely in a trading range here. So if you are selling, it's probably a scalp, maybe test the 73 close at best, but we're probably going more sideways than down at this point. It's also an outside bar, so trading range bar. And then look where 78 ended up testing. It's the close of 73 where bears got trapped, and what are they going to do on the retest? Well, if you sold here, probably best to get out here. Maybe you hold and see what happens here, but when there's hesitation and then a pullback, you just get out because the market's more likely in a trading range. 74 to 76, strong enough for a second leg, maybe a deep pullback and then a second leg. It's so late in the day, not really worth doing anything here, but the price action is still price action. 79, inside bull bar, might be the start of a second leg up. We're testing the low of yesterday. You can see we had a failed breakout below, and then a second attempt that's also reversing. Buyers below 79, maybe sellers above because the moving average and it's high in a trading range, but the sellers may not come in until up here. So we rallied on 80. Just one more bar in the day, really not worth doing anything. Consecutive bull bars, crossing the moving average, but the context really bad. Bear trend line and overall trading range. Possible leg one, second leg trap, and then disappointing bar 81 for the bulls. For always in today, I was hesitant with calling anything in the beginning of the day always in long, and that's because of the context. I think it's dangerous when the market's doing the low probability thing. So technically you have a big bull bar 7 followed through 8. It must be always in long. But the higher time frame, you know you're high in a trading range, and that means always in is backwards. And that means if it's always in long, it could easily be a buy vacuum test of resistance, and we could reverse quickly. So that's the importance of getting out below a bear bar in a context like that. And then I thought it was always in short by bar, if not 18, then by bar 19. And it remained always in short for the rest of the day. Every bull bar and pullback you see along the way down is really minor. When did the bulls get a rally that broke a significant trend line and rallied above the moving average? The answer is nowhere. Where's the trend line break? You can always argue there's minor ones. Here's a minor one. We just got above it but went sideways. The bears redraw it. Here's another one. We poked above it, reversed. And so there's no significant trend line break. And the bulls, they really didn't get a close above the moving average since the beginning, the first 16, 17 bars of the day, until I don't know, maybe these, just barely, and then the last 1 or 2 bars of the day. And so that's not strong enough to be buying. So at the very least, what's important on these days is to not be buying on the way down. And if you can at least stop buying on the way down, that's a start. And then of course the goal is to start selling. But the biggest thing is you need to not be buying on the way down here, convincing yourself it's a major trend reversal. For stop orders today, I'm always going to go back to the fact that we were high in a trading range in the opening range. So for me personally, nothing for me to buy. But you can argue always in long and bull breakout and follow through. You can buy above bull bars closing on their high, bar 4, 7, 8. But be very quick to exit. And then I thought 14 was a reasonable stop order trade. It's a second reversal down, possible final flag. And then I thought you could sell below 17, sell to close 18, sell to close 19, sell to close 20, scale in, low 2, below 27. And when it's always in short, you can really sell for any reason. So any bear bar closing below its midpoint, you can sell below. Obviously, some are better than others. Like here, 38, the context isn't ideal because some computers will see it as 3 legs down. And that can lead to a deeper pullback. That's the danger with leg 3. And what's the expectation after a wedge? Well, in this case, it's fairly tight, so you're not expecting a major reversal, but maybe 10 bars and 2 legs sideways. And we didn't quite get 10 bars, but you could argue this was all the correction from it. So maybe we did get about 15 bars sideways before we continued down. I said here, not an ideal signal bar, but because of context, it's a reasonable stop order sell below 47 and then 58. Another good stop order trade. And then here, kind of hard because there's a lot of overlap and it's a channel testing support, so really hard to do anything in here. And then maybe you buy above 74 if you're aggressive, but it's a scalp. And that's about it for stop orders. Again, maybe here you can sell below 77, and that's also a scalp, and that's your target. Limit order trades today. Buyers below bar 5, unlikely to be a major reversal. And then up here, sellers above bar 11, sellers above 15, sellers above 24, sellers above 28, sellers above 30. These are bad stop order trades. Inside bar 35, even though it's a bull bar, there are sellers above, scaling in higher, maybe a breakout point. We didn't quite get there. And then sellers above 43, trapped, but they can scale in and be fine. Sellers above 46, bad stop order, at resistance, rally in a bear channel. Same with here, high 1 but bad context, sellers above 56, 57. Sellers above all these bars. It's a tight bear channel, but again, not ideal. So maybe you sell above 61, knowing that it's likely we get to the low of yesterday. But in here, maybe better to wait and see what we get. Then, I don't know, 75, you can see we rallied and tested bars to the left, but it's hard to say where we're going to stop. Do we test here, here, here? Hard to know. Sellers above 76, inside bar after maybe 2 legs up. It's a smaller pattern, but we rallied, pulled back, rallied, inside bar, high in a trading range, and then outside down. And that would basically do it for limit orders today. So where do we go Monday? We know the market's been sideways for a couple of weeks, and that's what I expect to continue, but I do think there's an added increased risk that we go lower and test the moving average. That's a start, because bulls are buying above the average price up here, but we're not getting above average bullish price action. And so we might have to go lower to find buyers, and the absence of bulls buying will force the market to go lower to find buyers. I think if we stay within the range, there will be sellers above this bar, sellers high in the range, and maybe buyers below, but that increased risk that they may not come in until here or some breakout points to the left. And as always, please feel free to leave questions in the comments and include timestamps for any questions specific to this video. And I hope everybody has a good rest of their night. Thanks for watching.